Howdy, Wall Street Willie. Why do people invest in stocks? People invest in stocks with the intent to earn money, either in the form of dividends or capital appreciation. Dividends are a portion of the company's profit that's distributed among its shareholders. Capital appreciation is the gain you make when you sell your stock at a higher price than you bought it for. What causes stock prices to go up or down? Many factors influence stock prices, including economic trends, market conditions, interest rates, investor sentiment, and unforeseen events such as natural disasters. However, the most important factor influencing stock prices is the company's performance. This happens because of demand and supply. Investors will buy stocks of companies that do well and sell stocks of companies that do poorly. Therefore, if the company does well, it has growing revenue, market dominance, and high profits, the stock price will go up. But if the company does badly, its revenue decreases, it has increased competition, and profits are low, the stock price will go down. In general, the stock market tends to go up over the long term. Who should invest in stocks? Stocks are a high-risk, high-reward investment that are ideal for medium to long-term investment. So you should only invest in stocks if you have at least 7 years before you plan to sell. Those who are just starting out in their career and are saving for a long-term goal like retirement can absorb and recover from any losses before they need that money. This makes them ideally suited for stock investments. People approaching retirement, or those who have expensive goals like a wedding or buying a home coming up in a couple of years, should avoid stocks and instead opt for less risky investments like bonds, CDs, etc. How can I invest in stocks? That's a great question, Super Cooper. Watch the video on your screen to find out. Thank you very much, Wall Street Willie. You're welcome, Super Cooper. Remember, finance is your friend.